If you woke up tomorrow and your life savings had vanished, would you even see it coming? Because right now there are four warning signs flashing in the market. The same four signs that appeared before every major crash in history. Before the Great Depression, before Black Monday in 1987, before 2008 when people lost their homes overnight. And here's what terrifies me. Most people have no idea what to look for. They think crashes just happen randomly, out of nowhere. Bad luck. But that's not how it works. Every crash follows a pattern, the exact same pattern over and over again, going back 400 years. Hi, my name is Bob, and I've studied market crashes for over 2 decades. And today I'm going to show you exactly what those patterns are. From tulips in the 1600s that sold for the price of a house to the housing bubble that destroyed entire neighborhoods. We'll walk through each major crash in history, and I'll show you the four warning signs that showed up every single time. And then we'll look at what's happening right now in today's market. Because once you know what to look for, you'll never be caught off guard again. You'll see the crash coming before everyone else panics, and you'll know exactly what to do to protect yourself. So make sure to stay until the end, leave a like, and let's start. The first pattern, when everyone thinks they're a genius, let me take you back to 1634, the Netherlands. They'd just broken free from Spain, they're dominating global trade, and money is pouring into the country. It's their golden age, kind of like America after World War II. And this is where we see the world's first recorded market crash over flowers. Yeah, you heard that right. Tulips. Now, before you laugh, understand that tulips weren't just flowers back then. They were rare, they were beautiful, and most importantly, they were expensive. According to historian Edward Chancellor, 1 pound of tulips sold for about a month's average salary. That's like paying $3,300 for flowers today. Crazy, right? But here's where it gets interesting. Wealthy people started buying these tulips to show off, like a Rolex or a Ferrari today. They'd even commission portraits of themselves with their tulips, status symbols. Then something changed. People stopped buying tulips because they liked them. They started buying them because the price kept going up. And when prices go up, more people want in. Everyone's thinking the same thing. I can flip this for more money next week. The Dutch even invented futures contracts for tulips. You could buy a contract today that guaranteed you tulips next season at a fixed price. But as tulip prices kept climbing, these contracts themselves became valuable. So people started trading the contracts, not the actual flowers, just paper. At the peak, some tulip bulbs sold for the equivalent of 5 years of average salary. That's $200,000 in today's money. The kind of money you'd spend on a house, not a flower. Everyone was confident. Everyone thought they were smart. Even if prices drop, they told themselves, I can just grow more tulips and sell them when prices go back up. This is what we call irrational exuberance. When people stop caring about what something is actually worth and only care about selling it to someone else for more money tomorrow. And then it crashed hard. Tulip prices collapsed. The futures market dried up. Land values plummeted. Everything connected to the tulip trade was wiped out overnight. A pamphlet from that time said it best. Many a plowman has high hopes when he sows his grain, and all he reaps is stubble. But a tulip grower responded, no, this is too sure of a business for that. Come now, have a drink. Getting drunk on hope while ignoring risk. That's the first pattern, investor overconfidence. The second pattern, when the rules can't keep up, fast forward to the 1920s, America, the roaring 20s, jazz music, art. Wealth like the world had never seen before. The Industrial Revolution had created fortunes. Regular people were becoming millionaires through the stock market. It felt like a new era, and in many ways it was. But here's what was happening behind the scenes. A new type of investment company had been invented, the leveraged investment trust. These weren't normal investment funds. They borrowed money on top of what investors put in, debt, leverage, and they used that borrowed money to make bigger bets. When things went up, the gains were massive, but when things went down, the losses would be catastrophic. And now, for the first time, regular people could use debt to buy stocks too. Your broker would call you up and say, hey, why use just your money? Borrow some more, and your returns will be even bigger. And why wouldn't you? Everyone knew that markets always go up. Sure, there had been crashes before, like the Panic of 1907, but this was different. It was the modern world. Technology, advanced financial models, professional brokers who knew what they were doing. The government wasn't worried either. The economy looked great. Politicians stayed in office when the economy was good, and they didn't really understand what these bankers were doing anyway, but their own investments were doing well. So why rock the boat? This was the laissez-faire era. Let the markets run themselves. Don't interfere. President Calvin Coolidge even said the chief business of the American people is business. So the big banks kept piling on more debt, making bigger bets. These leveraged investment trusts started trading at double the value of the actual stocks they owned. Imagine buying a hedge fund today that's worth twice as much as all of its investments combined. Insane. The goal wasn't even making returns anymore. It was getting more investors to sign up so they could pump up their valuations. Everyone was in the market. Shoe shiners were giving stock tips. A little girl from Kansas mailed $4 to Standard Oil to buy stock. People were writing articles declaring, well, we've entered a new era. No more boom and bust, just endless growth. Then 1929 happened. The market collapsed. It dropped 89% over the following years. The biggest crash in history. That little girl's Standard Oil stock, by the time she got her shares, it had already dropped 15%. It would drop another 10% the next day. What followed was the Great Depression. 1 in 4 Americans unemployed, families losing everything, bread lines, homelessness, devastation, cheap credit from the Federal Reserve had inflated the bubble. The new debt-fueled investment industry had drowned everyday investors in false confidence, and the government had done nothing to stop it. This is the second pattern, regulatory shortcomings. When the people in charge either act too late or don't act at all, when the rules can't keep up with what's actually happening in the market. After the crash, the government finally responded with the Banking Act of 1933, also called Glass-Steagall. They separated commercial banks from investment banks. They introduced FDIC insurance so people wouldn't lose their deposits just because a bank made a bad bet. They learned the lesson. It's not about whether you regulate or not, it's about balance. Too much regulation stifles growth. Too little allows instability to build up until it explodes. The third pattern, the innovation nobody understands. Now we jump to the 1980s, Wall Street's golden age. Bankers went from back office number crunchers to some of the richest people on earth, and computers changed everything. Suddenly, banks could create complex financial products that would have been impossible before, new ways for hedge funds and pensions to invest beyond just boring old stocks. If your bank invented the next big thing first, you'd lock in massive profits. Your bonus would go through the roof, even if it hurt the investors. The hot new innovation in the 1980s had a simple name, portfolio insurance. It came from 2 professors, Black and Scholes, who wrote a paper about options pricing. Banks took that idea and ran with it. The concept was simple. If the market started dropping, your bank's computer would automatically place small trades betting against the stock. That way, if stocks kept falling, those trades would offset your losses. Like a seatbelt for your investments. By 1987, over $80 billion was being managed using these computer models. Banks trusted it. Investors loved it. Finally, technology could protect them from losses. But here's the problem. The system was complicated, so complicated that even the banks themselves didn't fully understand how it could backfire. At the same time, the 1980s were also the era of leveraged buyouts, hostile takeovers, Carl Icahn and other investors were making billions flipping companies overnight. It became a mania. Investors started buying stocks just hoping someone would come in and buy the company at a higher price. Pure speculation. At the peak, someone anonymously announced a $6.8 billion takeover of a company. The stock shot up 7 times overnight, except the investor turned out to be just some guy from Cincinnati who worked at a small advisory firm. He wasn't buying anything. The stock crashed back down immediately. That showed how frothy the market had become. Even fake rumors could send stocks soaring. Then in August 1987, the market started sliding, slowly at first. Just a normal dip. But the computers were watching, they started triggering sell orders just like they were programmed to. Small sells to limit losses. Except nobody realized what would happen if everyone's computer started selling at the same time. The market started dropping faster, which triggered more sell orders, which made it drop even faster, an avalanche. At one point, a specialist on the New York Stock Exchange had a crowd standing in front of him with 500,000 sell orders for a single stock, and nobody wanted to buy at any price. When the smoke cleared, October 19th, 1987, Black Monday, was the worst single-day drop in stock market history. Even worse than 1929, this is the third pattern, a new innovation that nobody fully understands. Something that seems revolutionary at the time, but has hidden risks that only show up when it's too late. The fourth pattern, when debt gets out of control. Now we get to 2008, the crash I remember most clearly because I lived through it. From my perspective, it felt like the system broke overnight. Wall Street bankers 2,000 miles away had basically destroyed my neighborhood. Friends had to move away. Houses sat empty. Some neighborhoods still haven't recovered. This one started after the dot-com crash in 2000. A lot of investors were scared of volatile tech stocks. They wanted safer investments like housing, and the banks were happy to deliver. They created mortgage-backed securities and CDOs so complex that even they didn't fully understand the risks, but the effect was simple. Hand out mortgages to anyone with a pulse, then package them up and sell them to investors without telling them how bad those loans actually were. This is the fourth pattern, the buildup of debt. In the years before 2008, household debt grew rapidly. Clinton had pushed homeownership hard. The Federal Reserve under Bush kept interest rates low for half a decade, encouraging cheap borrowing. Nobody wanted to stop it, not the government, not the banks, not the borrowers who were being pushed to buy the biggest house they could get a loan for. Banks stopped serving homeowners. Their real customers were the investors buying up these Frankenstein securities built from risky loans that nobody had bothered to check. People told themselves it must be different this time. Housing prices can't drop. They're not making any more land. But housing prices did fall. On September 15th, 2008, Lehman Brothers collapsed. One of the biggest investment banks in the world, running for over 150 years, gone. Unemployment surged. People lost their jobs and their homes. Entire neighborhoods never recovered. The subprime mortgage market unraveled between 2007 and 2010. It dragged down stocks, froze the global economy, and triggered the worst financial crisis since the Great Depression. And if you look back, all four patterns were there. Investor overconfidence, regulatory failures, innovation nobody understood, and massive amounts of debt. So now you know the four patterns, but how do you spot them in real time? Here's what to ask yourself. First, investor overconfidence. Are people investing without considering what something's actually worth? Are they just buying hoping to flip it for more money tomorrow? Second, regulations. Is there a new market popping up without any guardrails? Or are regulators swinging in too hard on a market that wasn't ready for it? Third, new innovations. Is there a new type of investing or asset that people are putting money into without fully understanding it? Are people saying it's different this time? Fourth, debt. Are people buying investments with money they don't actually have? Is the system leaning too heavily on borrowed cash? I can't answer these questions for you because the answers change depending on when you're watching this, but the patterns stay the same. And now you know how to spot them. Let me give you 4 things to do and not do when the market crashes. First, don't sell everything and move to cash. It's tempting, but crashes often come with high inflation. Sitting in cash just makes your money shrink over time. Second, be careful with alternatives like gold. Yes, gold prices tend to rise when stocks drop. But when you factor in dividends, stocks far outperform gold over the long run, over the past 100 years, over 50 years, even over the past 30 years. Third, don't try to time the drop. It's one thing to spot patterns that suggest a crash might be coming. It's another thing to predict exactly when it'll happen. Long-term investing still beats jumping in and out of the market. Fourth, invest when you have the chance. Crashes are when stocks go on sale. If you can cut back expenses or increase your income, anything you can put into stocks during a crash will compound massively in the future. Look, market crashes are scary, and we will eventually see another one. That's guaranteed. But having a plan and understanding these patterns means the next crash doesn't have to take you down with it. You now know what to look for. You know the 4 warning signs that show up before every major crash: investor overconfidence, regulatory shortcomings, poorly understood innovations, and dangerous levels of debt. History doesn't repeat itself exactly. But as Mark Twain said, it does rhyme. Stay alert, stay informed, and you'll be ready when it happens. Subscribe for more videos like this and click on the next one. See you soon.